All right, welcome everyone. I'm Kevin Davey, and today we're going to tear apart a strategy, and I'm going to give you some concrete things you can walk away with when you look at a strategy, especially one you didn't create. This would be one you might see out on the internet or read about or something like that. These things will definitely help you. So first of all, I want to thank you for joining me. Um, whole bunch of people. So obviously this kind of hit a nerve with a lot of people that they want to examine strategies. Uh, Over 500 people have registered. Not everybody, of course, is on the call. I have people all over the world. I don't think people in probably in Australia and New Zealand are joining me live, but it is going to be on YouTube, private YouTube for a couple days at least, and you'll get an email about that telling you where to go in case you need to drop out or something happens and you lose your connection or something like that. It will be available on YouTube, and you'll get an email from me on that probably tonight. And then eventually it'll probably be released to the public, but you guys get it first. All right, so this is not a sales pitch. I want to make that clear. I'm not going to have, some kind of, oh, hey, if you order in the next 10 minutes, you get something or blah, blah, blah. Uh-uh. This is just education. I will mention some of my background just so for people who are new to me and who don't know me. And at the very end, I'll give you a couple slides if you're interested in more information, but that's only if you're interested. If you're not interested, hey, you just watch everything else, and you're going to walk away knowing a lot more than when you came in. I can pretty much tell you that because the things I'm going to talk about some of them might seem kind of simple. A lot of people don't do them, and a lot of people ignore them. And when you do, you make some bad decisions. So we're going to be making good decisions based on some real data. So, okay, so like I said, first I'm going to give you a short intro just on me for those of you who don't know me. I know a lot of you do know me. You're either already students of mine or you're on my email list, but there are a bunch of new people too. Then we're going to tear apart this strategy. I said in the email, limb from limb. That's a little graphic, but we are going to tear apart what we can with it. Then we'll have Q&A, probably 10, 15 minutes. As long as you guys have questions, some people are already submitting questions, so we should have a bunch to go on. And it can be off of the topic I'm talking about today too. I'll try to hit everything. Anyone who's attended any of my things before understand that I'll answer just about any question. Uh, yeah, Richard is saying he has no sound. Um, I don't know how I tell him. Hang on, let me uh, send him a quick message. Your end, because I think everyone else can hear me. So we'll do that Q&A, and then at the very end, we're going to do a book giveaway so you can get copies of my book. And someone else said they can't hear. So if you can hear, just type a Y in the chat box. I just want to make sure that everybody can hear. Okay. So it's just a couple people who can't. So anyways, um, so that's our agenda. I only want you to just sit back, relax, and just take in this education. Don't feel pressured because there is no limited time sales pitch coming. Okay. All right. So first, our disclaimer: don't trade with money you can't afford to lose. Past performance is not indicative of future results. Treat all results as hypothetical, and realize that any trading system you see the results of are going to be with the benefit of hindsight. Keep those things in mind. You may find yourself in a lot better position. That's for sure. So disclaimer number two, the strategy you are about to see is real, but I don't give you any names of where I got it, who I got it from. They've been changed to protect the innocent, as the TV show Dragnet used to say back in the old days. And resemblance to any other strategies or any vendor is purely coincidental. So don't see what I show you and think, oh, hey, this other vendor has a strategy similar. Kevin must be talking about him. I'm not talking about any particular vendor. It's just not worth my time to try to debate most of the knuckleheads that are out there. And yeah, as you know, there are a lot of them. And hopefully you haven't gotten your money taken by them. So those are the disclaimers. Here's the strategy. So I found this strategy just somewhere. This was over a year ago. I found it. It was a black box. So it gave you the results. You could run it in TradeStation, but you couldn't see the code. Really, there are hackers out there who will decompile the code for you if you really wanted to, but I didn't do that because it's illegal, right? So I just wanted to look at it just with the lock code. How much could I figure out about this strategy? What kind of conclusions, observations, things could I make about it? Okay. Here's what it looks like. And you say, okay, well, it's upwards and to the right. So far, so good. Okay, so let's start looking into this. Okay, so I just mentioned that. I downloaded it. I put it on my development rig, not on my live trading computer. And I just thought, I looked at the trades and then started to dig a little deeper. So we're going to get into that. But first, that's what's coming. For those of you who don't know me, I'm a trader. I write, I consult. I've been trading 30 years. The last 15 or 16 have been full time. And 3 years in a row, I had over 100% annual return in a worldwide futures trading contest with real money. So I either came in first or second place 3 years in a row. And so I actually put my money where my mouth is. So my consulting is I've done consulting for hedge funds, for some startups, for some CTAs, and of course, some private people have just literally said, hey, come to my house for a week and help me out. So you might have seen my books. There's 5 of them. They've all been bestsellers at one point or another. And the one on the top left is my first book. It's the biggest one. It's also the most expensive one. It's been out now, I think it'll be 10 years this summer. So it's been around for a while. And the other ones are a little bit newer. So part of what I do is I run a workshop. It's called the Strategy Factory Workshop. It's actually won Best Trading School, third place or second place 4 years in a row. I don't have this year's results, but hopefully I'm in first, second, or third. And with it, my students learn how to build algo strategies. So that's what I'm all about. Because so many people build strategies, but they do it incorrectly. They backtest incorrectly. They over-optimize. They do all sorts of dumb things. My course teaches you how to do things the way I do it, which maybe is not the only right way, but it certainly is a right way. And I've actually taught or consulted with 8 trading contest trophy winners. And the picture in the middle with the red arrow is Ivan from Argentina. He won last year's trading contest. And you can, I'm not going to mention the name of the contest people, but you can Google it and certainly find out. It's the same contest Larry Williams won way back when. So those are just some pictures with some of the other winners. And then a lot of my students have had success building strategies. These are 2 group pictures of people who've taken my online class, and then they've come to Cleveland. I've done a live event 2 times, And the picture on the left, my backyard, that's Lake Erie in the background. And they came from all over the world. The one on the right was during COVID, so most of those people were from the US, but they actually took the class and then decided they wanted more and came to Cleveland, which, if you know Cleveland, it's a nice, really nice place, but it's not a tourist destination. So they're not coming here to vacation. They're coming here to trade and learn how to trade. So I've had a lot of successful students. So that's a lot about me and a lot about what I've done. So let's get back to the strategy. So, the first question, would you rather trade this or would you rather trade something else? That's kind of the thing you got to ask yourself. And a trader may not know what to look for right off the bat, but here's some things. So first, take a look at the equity curve. Now you got to be skeptical of it, okay? And I look at that equity curve and I say, okay, that seems reasonable to me. Okay, what would be unreasonable? Well, if you see something that is a straight line, that's not reasonable. Okay. If you see something that maybe goes up and has just a little draw, that's probably not reasonable either. This one has drawdowns. It has flat periods right there. There's another drawdown. So to me, it passes the eye test, the first eye test, where it looks reasonable. Okay. And that's observation number one. It is not too good to be true. It seems realistic, and that's a good thing. So that's a check mark for this strategy. Okay. Now, you might say, well, hey, uh, how do I know what's too good to be true? That's something you gain with experience. But like I said, if the better it looks, the more skeptical you have to be. And that gets a little tricky because most uh, people selling systems out there are going to make it look as good as possible, right? And I'll tell you what happens. This isn't an observation, but this is something to keep in mind. You'll see a straight line, or let's just say you see one that looks a little bit better. Maybe it looks like this. Okay, so that's a little bit better, right? It's not as flat here. And what most people do in their mind is they think, I know that's not real. I know I'll never achieve that. But what if I can achieve half of that or even a quarter of it? So maybe I'll have an equity curve like that. That should still be pretty good. Watch out if you start thinking like that. And I know a lot of people do it because I've done it, where deep in your mind, it's not totally realistic, but you think, well, even if it's half realistic, I can do it. And that would be great. That's how your mind plays tricks on you. So watch out for that. But just taking this equity curve and you don't know anything else about it, you don't know any of the statistics, you don't know if it's in sample, out of sample, walk forward, you don't know. You just know just by itself. Okay. Well, at least there it looks realistic. Now, a lot of strategies you can eliminate right off the bat because they just don't look realistic. Okay. And it's a start. Then we look at the profit. Now, this back test is about 4.5 years and it made $115,000. So I got to find my calculator. And what's the math there? 25K a year in the ES. That's really good. I said nice here, but you find a strategy that gives you an average of 25K a year. And I'm assuming this is trading one contract. Maybe it's not. but that would be pretty good. So certainly what looks good, okay, it's reasonable, it makes a lot of money. Okay, cool. Well, then I went to the strategy properties and looked at all the inputs for this. And lo and behold, there's a input that says end contracts, which I assume, I can't see the code, but I assume is number of contracts. So the number of contracts is 3. Okay. So that means part of the reason they're showing such a big profit is because you're trading 3 contracts. That's bad, because that to me is implying some deception. Why would somebody pick 3? Why not pick 10, 5, 8? Why 3? And I'll tell you why, because I've seen it done before. People do that, meaning the system sellers, because they're assuming people think it's one contract. Like if you've ever seen my material, you see everything I post, usually I say is one contract. That's a good benchmark. Then you can calibrate your mind to one contract. So this person's kind of taking advantage of the normal thought of one contract. What's even worse is the people who have some money management position sizing kind of snuck in there. It doesn't look like it on this one, but they show something like this, where they show that kind of thing, where here you're trading maybe 50 contracts and here you're trading one. Uh, you know, that's all just a fallacy. Because one, most people could never trade 50 contracts. I could tell you, I've never traded 50 ES contracts. I mean, that takes some guts. And a lot of people will say, oh, it's easy. You just go from 1 to 50. Psychologically, it's really hard. But that's another trick you see here. So overall, this observation, I'm saying this is bad that they're doing this. They're up to some kind of trickery here, that they pick 3, and it's probably to show good profit. So that's observation number 2 that you should look for. And there it is with when you settle it back to one contract. So I changed end contracts from 3 to 1. Now it makes 30,000 over 4.5 years. That's a lot more reasonable and a lot better. It certainly doesn't look spectacular anymore. Okay. And again, you guys have questions, just keep them coming. I will get to them at the end, but I kind of want to just go through this and kind of keep the flow of this presentation going, but there'll be plenty of time for your questions. And I see people typing them in now, and that's awesome. Okay, so the third observation, look at the performance report. So this is just a summary page. I don't show everything here. A couple things, though, that pop out right away. You notice it's not taking any short trades. I'll discuss that a little later. The other one, it's the big one, is look what this developer left for slippage and commission. 0. That's a warning sign, folks. Now, on this particular strategy, there's only 133 trades, so it's not going to be a huge amount. But in general, when people neglect slippage and commission, there's a reason for it, okay? And the reason usually is because the strategy looks a lot worse once you include it. So, hey, it's easy to not include it because most people don't even know to look for it. That's bad. So observation number 3, not including slippage and commissions. That's bad. In this case, I went and added in slippage and commission. It means about a 12% reduction in net profit. So it takes down the 32,700 down to 29,000 or something. Not a killer, but still, if you're going to be realistic about what you're doing and about why you're running the back test, you want to be realistic, right? You've gotta include slippage and commission. This also is going to affect your drawdowns. Now, your drawdowns are going to look a little worse because that slippage and commission is always every trade it's taken against you. So watch out for that. This is a hallmark of a lot of people who are trying not to tell you the whole story. Okay? Maybe it's intentional, maybe it's not. Scalping strategies, they're the worst for this, obviously, because they're trading a lot. And there's a whole other world with scalping strategies that won't even get into, but it's turns out it's really easy to fool most backtest engines, no matter what software you use. It's really easy to get inaccurate results, and your backtest will show one thing, and then you go live, and then it just doesn't work the same at all, and you wonder why. And it's not necessarily just because of slippage and commission. It's also just because of the whole scalping thing. So, all right. So that's the first three. One was good, two were bad. Another one, I went and looked at the strategy properties. Now, there's something called look inside backtesting, and I won't go into details about it, but if you don't know what this is and you don't know what it means, and you're going to be algo trading, you've got to learn this. Absolutely, 100%. You've got to know what it means, and you've got to know when it applies and when it doesn't, and you've got to use it. And basically, if I had to summarize it real quickly, if you have a strategy that could have multiple fills during a bar, chances are you're going to need look inside bar backtesting. So, quick example, think of a daily bar, and you enter at the close today, and you put a stop and a profit target that are going to be well within tomorrow's high and low. You pretty much know that. You know how much range there is. So let's say it was ES. You have a 2-point profit target and a 4-point stop loss. Chances are both would be hit the next day. The question is, which is hit first? And if you're the backtest engine, how do you figure that out? Well, without look inside bar backtesting, you can't figure it out. Okay. Uh, and you won't know. You've got to look inside that daily bar and break it up into pieces to see what happens first. So this is huge. I can't tell you how many strategies over the years I've seen where it took advantage of this, and you wouldn't see it from the equity curve. You'd never know. You'd look at the equity curve and think, oh, this is great. It's only when you dig into it, which you can do. Again, this is a black box strategy. So I can't see the strategy code, but I can see how the settings were in the software. And I can see in that red box, this look inside bar back testing is not checked. And then I know, yeah, maybe it doesn't need it, but you got to test with it. You certainly should look at it. Okay. And let me clear that. Okay. So I tested it. So I went ahead and tested it. I checked the box, tested with 1 minute. Turned out for this strategy, there was no difference. The results were the same. Okay. So I said, okay, well, that's okay with this one then. With this strategy, the developer did it good as far as, hey, he didn't check it. Turns out it didn't need it. So that's fine. But there are going to be lots of times where you do need it. And when you don't check it, it's going to lead to inaccurate results. And I've literally seen backtests that were profitable, that looked nice, turn to complete and utter disaster when you include this. Now in multi-charts, I think it's called bar magnifier. I think it's called bar resolution and NinjaTrader. I might have those terms wrong, but I know those two. I have those two platforms too. I don't use them really for development too much, but I know they have that capability. And that's something no matter what trading software you use, make sure that it has this capability. Um, yeah, somebody said it might be called high bar resolution in Ninja. Yeah, that could be. So thanks for that. But really, really remember this because this is an important one. It's killed a lot of strategies and yet people still ignore it. It's amazing. So, okay, so that's observation number 4. And they're kind of getting a little more complicated as I go into it. And the other thing too is they're kind of building upon each other. It's like if you get a strategy that can run through all these observations and you could say, hey, not a problem, not a problem, not a problem. Uh, that's really good. So you could almost use this as sort of a checklist for for just what you're doing. And uh eventually this just becomes kind of second nature to you, really. All right, observation number 5. You might have noticed, and I think I saw a comment in there, the odd test period here, and that it's short. So for instance, it starts in 2018 and ends September 19th, 2022. Oh, that's a little weird. One, okay, it's only 4.5 years. So I don't consider that long enough to be a valid test. I think you need to go 10, 15 years. Okay. The other part of it is this September 19th. What happened on September 20th, right? Did this? I don't know. Well, I'll show you a little bit, but did it maybe take a whopper loss trade and do that? You don't know. Now, maybe, okay, let's play devil's advocate here. I like to look at things from both sides. Maybe this person developed it and ended development on September 19th, 2022. And maybe that's just what he's showing here. So maybe this is a valid date. Maybe that's when he stopped development and posted it on the internet for sale. And I came across it, I think in February 2023. Maybe this was already up there for a while. So I don't know. You don't know, but you add that odd end date, could be an odd beginning date too, and you add that with the short test period. And I'm saying that's bad. And so I'm thinking, that might be bad. So what am I going to do? I'm going to expand it on both sides. Okay. I'm going to go before 2018. I'm going to go after 2022. Here's what it looks like. So the part that's not in the box is more or less what the previous equity curve was. And you can see in from 2007 to probably 2018, this strategy didn't do so good. Now, again, because it was a black box, maybe he had certain code that would, if he had walk forward code, can't really do this. But I don't know. I don't know if he has it. So you gotta look at it. Um, the hang on one second. You can see it afterwards. So this could all be real time, and you could see it was making money for a while and then it kind of fell off. Okay, but altogether, does this knowing this give you more confidence that it's a good strategy or less confidence? I would say less, right? Especially this beginning part. Now, here's what a lot of people do. So this is just kind of another trick that both system sellers do and you can do to yourself. Maybe you run this back test and you see this and hang on one second. Sorry, I had a barking dog and I didn't want her to get on. You might have seen her in an email before, but she likes to bark. So I wanted her out of there. Anyhow, let's say you get this and then you say, well, in 2018, blah, blah, blah happened. Something happened. And therefore, uh, maybe I'll just exclude all this data. Okay. And then you say, I'll start my back test right here. Is that valid? Can you do that? No. uh, the people ask me that all the time. Well, because of something, I can exclude all this old data, right? I always ask the opposite. If the data, if the equity curve looked like this through that box, would you have said I should exclude it? And if the answer is no, because the equity curve looks good, then you can't use the opposite logic and say, well, just because it's bad, I'm going to exclude it. And no matter what the reason is, because I'll tell you what, people invent reasons all the time for things happening. It's so easy to do after the fact. If you came up with the reason before it happened, that would be a different story. So just an example, because we have the Super Bowl coming up this week, this weekend. Let's say, even though it's artificial turf, let's say uh, one of the teams just keeps slipping and their cleats, blah, blah, blah. And, they're just not getting traction. They have to change cleats and they end up losing because of that, or at least part of it. And they say, well, it's because the field conditions were so bad. Well, that's an after the fact explanation for it. And if they had really known that, they would have changed their cleats before the game, and then it wouldn't have been an excuse. Same sort of thing here. If you find yourself making excuses for bad performance, you're probably just inventing reasons. So you got to watch out for that. So observation number 5, you take the odd start, well, in this case, end date, and the short test period that was only 4.5 years. That's bad. Don't do that. Okay, so we're halfway through. Hopefully people are enjoying it. Hopefully people are dropping out because they're like, oh, this is dumb stuff. It's uh you might have noticed I think it's all fairly simple stuff once you know to look for it. But when you don't know to look for it, it can come and bite you, does it not? I think so. So if you're enjoying this so far, just type a Y in the chat box just so I get some feedback. And if you're not enjoying it, just type an N in the chat box. Yeah, most of you are saying yes, so that's good. All right, so let's move on to the second group. Now, I should mention before I go on to this applies not only for strategies you think about buying that are out there, it could also be strategies you build yourself. These could all be things that could be useful for it. All right. Now, let me back up. In TradeStation, and in most software has this, the normal curve is an equity curve line, and it's based on trade numbers. So every trade gets added to this equity curve. There's also a different equity curve that's based on dates. Let's just say instead of 800 trades, you had one trade. What would this closed equity curve look like? Well, you wouldn't see anything except for the endpoint. Maybe the last trade was here, and then your equity curve would look like that. It would be a straight line. But so this equity curve of versus trades only gives you some of the information. You want to look at the detailed equity curve. Okay, so let's look. Oh, Okay. There it is. And now I went back 2007 to 2024. Okay, well, sort of looks the same, it goes down, then it goes up, and then it goes up again, and then down at the end, sort of like our closed curve, except for that. If you remember from the closed equity curve, you didn't see a big flat period. So what is that? Well, that is a period where there were no trades taken. Okay. No trades were taken for that strategy. Okay. And you could say, well, hey, maybe it just didn't take trades. That's possible. And it could be just part of the strategy logic that it doesn't take trades. Okay. If that was true, I'd expect to see little flat periods all over here, right? But I really don't. All you see is this huge, long, prolonged flat period right there. So that raises my suspicion. And it's hard to tell from the dates here, but you can see this date, August 2020. What happened before August 2020? Somewhere right in here. Well, that was COVID. That was the start of COVID, was March. Well, depending who you talk to, really the market started getting hit with it in March. That's when they started doing all the crazy lockdowns and all that. So maybe it's a coincidence that this strategy stopped trading for a big period of COVID until we sort of got out of it. And then, hey, being long after COVID really was bad. That's probably a good thing, starting in like 2021, that probably would have been pretty good. So maybe that's all coincidence. Maybe I'm just, I got my tinfoil hat on and it's a conspiracy. This developer, it just happened that his great strategy didn't trade during COVID. There's nothing nefarious going on. Maybe, but maybe when he developed it, his strategy did this during COVID, or, did this sort of thing. And it's a black box, remember? So you can't see the code. This would be easy to do. You just put a little switch in the code and says, don't trade from the beginning of 2020 to the end of 2020 or whatever dates you want. He could have done that. And that's why you see that. Now, that's why, I had that disclaimer at the beginning. Any resemblance to any vendor or anything, I'm not, I said it's coincidental because I'm not accusing anybody of anything. Because I don't know. I don't know 100%. But what's the saying? If it walks like a duck, looks like a duck, quacks like a duck, it's probably a duck. It's an American saying for you not in America. Uh, Probably don't realize it, but you draw your own conclusions there. I draw the conclusion that's bad because I don't understand it. But if I saw that same thing, if I saw a flat period here, flat period here, flat period here, flat period here, if I saw multiple ones like that, I probably wouldn't be so attuned to that one, but it sticks out. And again, observing this and tearing this strategy apart is something that you've just got to be kind of skeptical of. Just because somebody says it's good doesn't mean it is. Remember, it's cause and effect here. This strategy is being sold. It was being sold at one point for $2,500. So the developer may be cheating. That's the cause. The effect is you losing money. And can you feel how bad that would be? Yeah, that would be pretty bad. All right. So again, got to ask yourself, is that normal or was that done intentionally? You'll never know because it's a black box, but certainly raises the red flag. And so far we're getting a whole, I don't know, what do they call a bunch of flags? It's, I guess, a bunch of flags. We're getting a whole bunch of red flags here. Okay. Observation number 7. Remember, I mentioned before that this strategy went long only. Okay. So going long only in an S&P strategy, S&P futures, one is a lot easier to develop than one that goes short. But two, it can be compared to buy and hold, right? Because, hey, why spend all your time developing a strategy, or why spend all your money, $2,500, buying this particular strategy when you could have just put it in a low-cost ETF, do the SPY or Vanguard's VOO, VOO. And there's a lot of other ones too you could do. You very little expense ratio, and you could have just had the curve more or less, this is futures, but you would have gotten the same sort of results with an ETF on the left. So you got to compare it to buy and hold. So let's do that. Okay. So buy and hold, ton more profit, almost 10 times the amount of profit. The net profit to the max drawdown, a lot better. That's a great risk metric. You want the lowest drawdown and the highest net profit. So you want net profit to drawdown as best as you can get. And it had 4 losing years, so it doesn't win every year. And it obviously it had some tremendous drops. But the black box system actually had 7 losing years. And you can see that from the performance report. Now, put it all together. Bad. Makes this bad. So it doesn't compare well to buy and hold. Now, the problem is you can't do this with every single market. Can you do it compared to buy and hold with gold? Well, I guess you could, but most strategies that people develop go long and short. And it's really hard to compare to buy and hold. Stock market's a little different because if you just go long, you're probably going to be in good shape. So, hey, that's just the way to go. But I could do it here because I knew there weren't any short trades and it was only a long only strategy. So I think it's pretty appropriate to compare it to buy and hold. So buy and hold, though, if you're going to be actively algo trading and you're going to be going long and short, you got to let go of the thinking of comparing it to buy and hold. But certainly it's an option for people. All right. Observation number 8. So let's dig in a little more. So I showed you this before. I opened up the strategy parameter window. And there's the number of contracts. Remember, I said it was 3. And then it looks like there's 5 variables that goodness knows what they do, except for the stop loss. I could probably guess that's a $1,462 stop loss, not $1,461, not $1,463, but $1,462. Oh, okay. And then it's got some crazy, a length of 12. Okay, just a bar length of 18. I don't know, Cinco belt. I don't know what in the world that is, or the adjuster, but they're all kinds of numbers, right? They're odd numbers. They don't look normal, right? 1462 is not a normal number for a stop loss. Um, hopefully everybody realizes that. If it said 1500, I'm trying to draw 1500 here. If it said 2000, okay, I can buy that. If these lengths were 10, 15, 20, or 21, which is like 1 month of trading, maybe it's based on daily bars, something like that, I could kind of believe. I don't know about these two, I can't really comment on because I don't know what they do. Maybe they're very normal for the Cinco belt indicator, whatever that is. Has anybody ever heard of that? If you have, type a Y because I'd love to understand what that is. And again, it's a black box. I can't see it. But you put them all together, all these five, forget about the end contracts. We've already hashed that one out. They look optimized. The implication there is the back test we had looked at was optimized. Oh, so that is not even out of sample data. That's in sample. That's an optimized back test. Of course, it's going to look good. It's an optimized back test. Optimized back tests always look good. And if they don't, somebody did something wrong. Why would somebody try to sell something with an optimized back test that looked bad, right? It's silly. But it also means you really have to discount that whole curve that we saw at the beginning because it's based on an optimized test. If you test something and optimize it, any data you use is called in-sample data, and that is just not good for the future. It just doesn't work going forward. Okay, so, buy and sells, hey, not bad, but hey, this is another red flag. All right, so now I found the strategy in February 2023. So for me, anything from that point on, if I look at, I downloaded it, been on my computer. So now the past year, from March 1st, 2023 to today, I can pretty much say is real-time performance, right? There was no way for this developer to sneak in new code or anything because the code was locked and it is what it was, or it was what it was. Here's how it's done in real time. And this is always something you should look at. This is observation number 9. Loses money. It doesn't look all that good. Certainly, uh, nothing that would entice you to trade it just based on looking at that. Who'd trade that? Now, obviously, it might turn around and start to do good, and you might change your mind. But just based on this isn't that good, right? And you know what? It's also consistent with what the previous one was, where I said that was probably an optimized backtest. Well, optimized backtests tend to fall apart with real data, and that's kind of probably what you see here. It's just not working. Those optimized inputs, that $1,462 stop loss, that doesn't hold up going forward because it was optimized. So that's what you got to realize. All right. Now, the last observation is an observation of what you don't know. So it's kind of weird. There's things you know, and there's things you don't know. And sometimes the things you don't know are pretty bad, but you don't know anything about this strategy because you can't see the code. So it might have all been faked. The person might have gone through and said, oh, on this day, I have to go long because I know the market went up that day. You don't know. You don't know how the strategy was created, how it was built. You can guess it was an optimized backtest. Almost certainly that's what this was, just based on what I've seen. But you don't know for sure. And you don't know if this dude had spent 5 years and he built 500 systems and this was the best system, or 1,000 systems strategies, and this was the best one of all of them, because that in effect is optimizing too, just in a different way. So There's a lot you don't know. And that's what makes buying any kind of system out there tough. And that's why I always recommend to people build your own. And if you build it with a proper test method and you follow a certain process, you're going to have a lot more confidence in it because you know how it was built. You know if you cheated. You don't know if this dude who's selling this system cheated. My conclusion, he probably did. But hey, I guarantee I feel that way. Probably a lot of you feel that way. But there's probably thousands of traders out there who would look at that, say, looks good, I'm buying. And, because they don't look at things like you and I do. And that's what it really comes down to. How would you feel if you had built this system and you knew everything behind it? Um, your conclusion would probably be like, I'm not going to trade it because I know it was optimized. But maybe if you did it right, if this was with walk forward testing and, the equity curve over the whole period looked good, you'd have confidence. So that's something to keep in mind. All right, so let's sum it up, and then we're going to move on to questions, the book giveaway, all the other fun stuff. So, has a realistic equity curve? Yeah, it passed that. It was getting a high profit because it was inflating the contracts. That's a little suspect. So that's bad. Didn't have slippage of commission. That's bad. It wasn't tested for look inside bar back testing, which would normally be bad, but in this particular case, it's okay. So I give it a good. Okay. And then the dates and the test length, you put those two together and you're like, yeah, that just feels a little icky. That's bad. So 3 of the 5 are bad. Look at number 6. It was turned off during COVID, no trades. I think that's bad. Maybe there's a perfectly logical explanation, but I don't know it. And the developer would never probably tell you it, but something to watch out for. It didn't compare well to buy and hold. It would have been better to buy and hold. Why waste your time building algo strategies when you could have just bought and hold, gotten a lot more money and a better risk adjusted return? I suspect it was over optimized just based on uh, the values, especially that stop loss value, $1,462. I mean, it's ridiculous. The real time performance, since I personally got the strategy and was in control of it, was mediocre. You could say, oh, maybe break even, but it certainly didn't make money. So that was bad. And then number 10, there are a lot of other things that I don't know about, but since I don't know about them, I have to say they're bad. I have to assume that they're bad unless I can prove they were good, and I can't. Okay, so you add up all 10 of those, 8 of them were bad. But I'll tell you, if any strategy you're looking to purchase, or even strategies you build yourself, if you look through these 8 things or 10 things, and the 8 that are bad, especially, you're going to find yourself eliminating a lot more strategies, but it's going to save you some money. That's what it's all about, right? You not only want to trade good strategies, that's part of it, but a big part of being a good algo trader is not trading the bad strategies. So keep that in mind. So when it comes down to it, really buyer beware. And my advice to everybody here, there's 80 or 90 people on this right now, somewhere around there. Learn to build your own strategies. That's the only way to really get confidence, in my opinion. Don't rely on other people just to, for you to buy strategies. Learn to build your own. And then you get some confidence, and your confidence grows as you start doing it. Where do you feel the best with this? Do you feel good about trading a black box, or do you feel good about trading your own strategy that went into it? You know, you just don't get into this too quickly. You can't build strategies overnight kind of thing. It takes a little while, but eventually you can do it. You just have steps you got to follow. And as we could see, don't rely just on the numbers. Most of those numbers I showed today can mislead you. And so that's why you got to dig into things a little bit better. And then the final point, after you develop a strategy, watching it live for a while is a tremendous idea. That's part of my process. And it works. It eliminates so many suspect strategies. It's really good. All right. So, if you want to learn more from me, just consider my workshop. It's not cheap, but I've packed basically 30 years of my experience into it. And not everybody is cut out for this. It's, trading's hard. And if anybody tells you trading's easy, they're lying to you. So this helps get you an edge in your trading. I consider it a master class, and certainly it's won a bunch of awards. You can go on Trustpilot and look at all the reviews. I make sure each one of those reviews are real people. I've had some fake people actually give good reviews. And, like somebody I've never heard of gave me a 5-star review. And so I complained to Trustpilot. I said, this person did not take my class. I do not want this. And they took it off. So you can believe those. I have, everybody who took the class who posted in Trustpilot is a real person. So the cool thing about this class, I give you 12 months of one-on-one email support. It's me giving you support, not some third party or third world or in trading intern or somebody who doesn't know. It's me. Try that with any other course out there. You're never going to talk to the person who created it, who uses it, and who has benefited from it. It just doesn't happen. I give you a bunch of strategies, but you get the code. They're not black box. They're fully disclosed. Some people trade them, some people use them for ideas, but you get them. You get to see what this process is all about with real examples. And if you don't, I use TradeStation. If you don't have TradeStation, they have some nice little incentives for people who join up because of me. I get nothing. I get zip from TradeStation. I use them because I find overall it's the best platform to develop with for a bunch of reasons. But you can get 50% off commissions on futures for life if you sign up with me. If you want that link, just let me know. And I also give you a guarantee. So I just had the first person I've had in almost a year, a guy from Hungary, took the class, and then, within 14 days, I think he said, I don't think it's for me. It's too complicated. I thought it was going to be easy. So I gave him his money back. But you have that. So you can always try it and see. All right. So anyways, more info. Just go to my website, KG Trading Systems, click on workshop up at the top, and you'll learn all about it. Or you can just scan the QR code here. I'll leave that up for a second. You can hit it with your camera, and it will take you to that page. Okay, so with that, we'll go to Q&A. I'm going to go back just to allow you, if you want to hit that QR code, but I'm going to go through questions and probably about 10 minutes, and then we'll have the book giveaway. So I'm just going to start at the beginning. There's a lot of questions. Okay, so the first question came in via email, and this is it's one of those that, sounds a little offensive, but it's really not. It's just somebody wanting to know. Okay. Hello, Kevin. I wonder why you sell courses and send out emails. If it is profitable with algo trading, why not just focus on creating better systems and become economically independent? Do you sell courses because it is fun or from an economic gain? I ask because if you are economically independent by now, you've been in the game so long. I don't want to be rude, but my question is it possibly profitable in algo trading? So, um, do I sell courses because it is fun? Yes. I like teaching people. I get a kick out of seeing people succeed. I get a kick out of seeing 8 people that I've taught win trading contest trophies. That's pretty cool. I like that. Do I do it for economic gain? I'm not doing it for free. So, yes, I give away a ton of stuff on my website, ton of YouTube videos, but I'm also doing this to make money, right? And my philosophy is more money is better than less money, right? I've got 3 kids who are first one starting college next year, and I'm thinking in the US, roughly for 3, roughly $1 million total tuition, room and board, and all that. And I want to pay it without saddling them with student loans for decades. Okay. That's just who I am and what I want to do. So, yeah, more money's definitely better than less money. Trading's risky. You can trade a whole day, week, month, and still lose money. And when that's your primary job, imagine going to work every day at your job, and at the end of the month, your boss says, well, you don't get a check this month. We're actually going to take money from you. You'd be like, what? That's what can happen in trading. So you want to have a balance between that kind of thing. So so that's why I do it. So it's obviously I love teaching. I get to be a better trader by teaching, but I also, there's obviously money in it for people who can teach it, and people are willing to pay for my expertise. Hey, why not, right? I think you'd all agree if whatever full-time job you had, somebody wanted to pay you on the side for something, you would take it on, right? That same sort of thing. And his last question, is it possible to be profitable in algo trading? Yes, it is. I'm not going to say it's easy because it's not. Anyone who tells you trading is easy is lying to you. So just keep that in mind. It's tough, but you can succeed. Okay, so let's keep going through questions. Just keep them coming. We'll stay a little longer as long as there's questions, and then we'll do the book giveaway. Okay, so the next question. When I do Monte Carlo sim using my Excel spreadsheet, it's on my website, it's free. Should I deduct slippage and commission and put those trades with slippage and commission? Absolutely, yes. And you can save the performance report in TradeStation. And if you sort it a certain way, all those trades will come in a row. You just copy them, stick them in the Monte Carlo. Okay, another question. I just completed reading Ralph Vince's book on portfolio management. What do you think of Optimal F? I was reading Van Tharp, and he seems to categorize it as risky. So Optimal F is a position sizing technique that's supposed to maximize what he calls terminal net equity or terminal wealth. It's supposed to maximize your gains. So when you try to maximize gains, you're also going to be taking some huge risks. That's what Optimal F does. And if things are like the past, so what you do with Optimal F is you look at the past data and trades and you say, okay, well, based on that, my calculation says Optimal F is whatever number, 0.2. That means I have to risk 20% of my money on every trade. And if your strategy keeps working forward that way, you should do good. But if it turns out your strategy falters a little bit, this will easily wipe you out. So be careful with Optimal F. Be careful with any position sizing method, especially when you apply them to back tests, because you already know the back test is good. That's why you're applying the position sizing. And so you're going to get unrealistic results most of the time. So watch out for that. Okay, hopefully people were able to hear. There were a couple guys who could not hear. Okay. What kind of consultancy do you do? So again, I've worked with some hedge funds and some commodity trading advisors and private people. What's the Sharpe ratio? Rick's asking of the equity curve. And Ibrahim asked the last question. Sharpe ratio, I don't know it offhand. I'd have to go and look. And is this all sample data? He asked this early on. As we went through, we found out that it's not. It's probably in sample data. So that's a good question, Rick. Mr. Mazzaferro. Oh, Mr. Mazzaferro, German Mazzaferro, please send me an email after, because your last name is in my wife's family tree, and there's not many Mazzaferros out there. So send me an email. We can chat about that. Anyways, he says usually commission and swaps are strategy killers. Absolutely. Great comment. David says, in your opinion, what separates good trading, making a living for outperformance, making a fortune? Well, one is probably not not saying right off the bat, I'm going to make a fortune, because usually the people who have the dollar signs in their eyes don't succeed because they're aiming too high. What you got to do is you got to aim for a good risk-adjusted return. That's kind of how you can do it. And making a living trading is not easy. I've said it a couple times. It can be done, but for most of you with jobs, with full-time jobs, the better way to do it is to start out on a part-time basis and then ease into it. That's what I did. Okay, I traded as a hobby sort of thing for years before I felt comfortable to go full-time. Okay, Lavro says, do you prefer to exit at the close using system profit stop loss orders, bypass those orders using 2 time frames? I do both. Some strategies I don't have stop losses, which I think I have a couple of YouTube videos of ones without stop losses or profit targets for that matter. And people get mad. How come you don't have a stop? So ultimately, you can do either, and it's whatever you feel comfortable with and what gives you a good risk-adjusted return. And what your risk-adjusted return is might be different than what I consider a good risk-adjusted return. Certainly I teach one in my class, but it's kind of how you look at it. John says, will recording be available? Yeah. Sorry, I didn't see that earlier. You're going to get a link to a private YouTube video tonight, and then probably by the weekend, it's going to be released to everybody. Okay, people were saying they are enjoying it. Okay, Ender saying, I'll take your course soon. I'm working on learning some more stuff. That's perfect. And anybody who's thinking about my class, feel free to send me emails. I'm pretty open, and I tell people all the time, no, this course isn't for you, or it's not for you yet. I try to help people. And I've literally last year, I refunded somebody who didn't even ask for a refund, but he signed up, and I was talking to him, and a couple times he mentioned that he was just disappointed in something. And I'm like, I realized he wanted to make like $1 million in a year, starting with 10,000. And once I realized that, I said, this course isn't for you. And I just said, goodbye. All right. So there's, if you still have questions, I would cut it off because now I have a lot of messages to get through. I have like another 20 questions. I'm going to try to do it in 10 minutes and then get you out of here by 2:30. Okay. Has anyone been able to build a short NQ strategy? I tried and they fall apart. An exclusively short stock indices strategy is really tough. But I had certainly, and others have strategies that do go short at times. And yes, that can be done, but Obviously, it's harder because that market tends to go up. Connor says Cinco belt is preposterous. Yeah, that's true. Okay, Colin saying, my question's about the code. I know some institutions have hundreds of thousands of lines. Mine is almost 850. Is that small? I built in protections and control of data flow with flags and lots of debugging. Uh, I literally have some strategies that when you take out the walk forward code are literally 2 lines. If this, buy, if this, sell short. So I tend to aim for simplicity. The more you add to it, the more variables you add is usually a bad thing. And there's some research that says, hey, if you add a super large number, maybe that's a good thing. But if you're talking 50 variables that you have to optimize, that's probably a bad thing. Okay. The debugging stuff's probably pretty good, but if once you build strategies, I tend to keep them pretty simple. You just want things that just seem to work, and then you don't have to worry. You don't want to conquer the world with a strategy. There is no holy grail of strategies. David has a question. How many of your strategies fall apart after development? What are the characteristics which tend to be the most robust? Number of trades will compensate, or in this case, is short term. So I always expect every single strategy to eventually fall apart. So I put in things in place to start with. Then I mentioned that real time, I call it incubation. There's a certain percentage of strategies that will fail. It could be you did something wrong. I used to look at every strategy and come up, why did this one fail? And then I realized I was just fooling myself of, just dreaming up reasons. Hey, some fail. Some had good luck. Some just get lucky. It's hard to say. And the number of trades really, to me, doesn't take away from the amount of time you want to trade it. What I look for, even if you're doing intraday systems, you want to see a lot of market cycles. And the only way to see that is not by a lot of trades, but it's by a lot of test period time. Okay. All right. What are the most robust ideas? I tend to like things like momentum. I talk about this more in my course, but momentum. If the close is greater than the close 50 bars ago, chances are you're in an uptrend. Chances are it's probably a good time to buy, things like that. But you've got to test everything because there'll be times where that idea is awful and there'll be markets where that is good and nothing works everywhere. Um, how much do you consider useful to set a strategy in a demo account? See if it's to understand if it's working. I never use demo or sim trading. I rely on the strategy back test, and I'll go in every month and look at what the strategy back test says for the last month. Now, the key to that is having a strategy that will work in real time. That's something I talk about in my course, but you want to do it for a number of months. Um, David says, are all the 16 strategies tradable? Yes. Yeah, they don't all make money every month, but together they've done pretty well. You can always send me an email. I can send you some equity charts. They're also probably on the workshop page. They might be a little out of date. JS is saying, do you believe in flexing position sizing due to market volatility? It could reduce position sizing in high and low to smooth the equity curve and possibly normalize risk. You can do that. The problem when you look at it on a risk adjusted basis is you have to make sure you account for how much you could have needed. So let's just say you have something where today it takes 1 contract, tomorrow it takes 5, the next day it takes 3. Okay, well, when you go to evaluate that on, a return on account basis, you better be planning on having the margin and the equity for all 5, which may be a lot more, 5 times as much more as if you were just trading one. A lot of people forget about that, and they'll still base their returns as if they were trading 1 contract, but they're really trading 5 sometimes. So watch out for that. What's your favorite symbol to trade? I trade all the major futures that are in the US. I don't think there's any one I haven't particular that I like because it would vary from time to time. A couple of years ago, when the Russians invaded the Ukraine, grains were undoubtedly my favorite because they were just knocking it out of the park. Um, so it does change over time. Abraham says geometric mean. Not sure. That might have been to optimal F. David, do you recommend having side income apart from trading profits? Everybody's different, but I will tell you this. So I remember I showed you that picture of people who attended my online course and then came to Cleveland in person. Part of that was we did a roundtable of everybody in that group. There were about 20 people, 30 people. There were 5 people who said they were full-time traders. That's how they identified as, okay? And so one of the questions was, do you do anything else besides just trade? 4 of the 5 people had side gigs, meaning one was a CTA, so he managed other people's money. One sold signals. One ran a family office. The other one provided research for people or something. There was one guy, um, his name is Sean. He's from Houston. He used to work for Enron. He was the only guy who says, nope, I just trade. That's all I do. So most people do have other income to kind of smooth it out. And that's what you kind of, I think a lot of people do. All right. David M is saying, I was fooled by many great marketers. Could you provide some average range of what to expect in the real world? Having at least 10 well-built strategies, could you make 30 to 50% on your average? He spent a few years trading. He quit his job, but I have no idea how much time or capital I need to really succeed. So 30 to 50% a year. Could you do it? Yeah. Is it hard? Yeah. Would you have to endure some big drawdowns? Yes. I talk about this in my course. I actually show you data from professional commodity trading advisors. They manage money professionally. If you want 30% year return, you've got to expect a 15 to 20, even 25% drawdown to occur. So that gets kind of scary for a lot of people to lose a quarter of their money chasing those bigger profits. That's how you got to look at it. Don't look at it just as return. Look at it as return relative to the risk you take for it. Okay. David F., have you participated in any trading contests since the one you won? Any plans on doing it again? I participated, I think it was 2012. I was doing an experimental strategy. It was going okay. And then the brokerage that I was with, if you watch the show American Greed, you'd find his episode where they found the owner in a car in his parking lot with a garden hose going from the exhaust into his car. He tried to kill himself. Now he's in jail. He basically was forging account documents for years. So after that, I didn't do it. And then I did it in 2000, I don't remember, 2017 or 21. I know it was during when I had a live Cleveland workshop, and I've only done 2 of those. And I was doing really well. And then I probably would have finished in the top 5. And then I kind of got reckless because I said, I got to get in the top 3. And I blew out the account, or at least I got out of the top 5. So I haven't done it since then. Does the 10,000 hour rule apply to being a profitable algo trader? That's a popular rule of thumb. So that's what, 40 hours, what is that? 40 hours times 52, that's like 5 years. It might be. Certainly for me, it was longer because I didn't know what in the world I was doing. But if you align yourself with somebody who has some proven success, you're going to shorten that a ton. Um, you know, there's going to be things that you don't know that this other person knows, and it's going to shorten that time frame. So, but you could also do 10,000 hours and never be successful. It's no guarantee. That's something you got to keep in mind. Okay, is it possible to use these strats with options? Yeah, the problem with options, no pun intended, is there's a lot of options to them. Meaning, okay, so let's just say you build a model for futures for crude oil, and it can predict, when to buy and sell. And you say, well, I'm going to trade this with options. Okay, well, now let's say you get a long signal. What do you do with options? Do you buy a call? Do you sell put? And then is it a 6 month to expiration option, or do you buy the near term option? And do you buy at the money, or do you go way out of the money? And maybe you do a straddle, strangle, butterfly, iron condor, all these different option things. Tell you what, it starts to get super complicated, and you could actually ruin a good base strategy by picking the wrong uh, option strategy. So, um, yeah, so Zamir posted something. I'm not sure what I'm looking at, but he has Kelly percentage and some other stuff. So, Zamir is already a student. Oh, those are his stats for January 2023. Thanks so much. Part of my success is owed to you. Oh, wow. Well, thank you. I appreciate that. Zamir has been a really good student, somewhat one of those students who you can tell just ask questions that are like, man, these are good questions. And a lot of my students are like that. And actually, part of my course, I invite people back all the time just to sit in, and then they ask some advanced questions. So it's kind of cool. You get the beginner people, or the new people, and you get people who've been doing it for a while. So his return on account was 18% for January. That was pretty good. And last year he made 90%. Wow, that's good. Better than I did last year. So um okay, Ibrahim, send me an email, Ibrahim, and I'll explain this Excel issue you're having. David F, do you use higher leverage risk in contest in order to achieve higher return? Yeah, so when you're trading a contest, one of the things I talk about in my course, the first step, and you guys have probably seen this if you've seen any of my material, is you got to have goals. What do you want to do with this strategy or your trading? So I wanted to win a trading contest. So what does that mean? I want to maximize my gain. I don't care about risk. If I blow out the account, so be it. So when you have that mindset, you're going to trade a lot differently than, hey, I got to trade for, long-term growth. So you got to have that up front, and then you just build a strategy that meets your goals. And it's super important. Almost nobody does it. So keep that in mind. Okay, Ibrahim, okay. So yeah, send me an email. I'll show you exactly what you got to do. Do you think discretion, experience, intuition can be used to improve algo systematic trading results? Possibly. But when you run a back test, you get a 10-year back test. Are you actually going to have 10 years of your intuition programmed in there? No, you're only going to be able to do intuition going forward. So what I would do, if you're convinced you're better than the algo, keep results for both, you know. And the only way I would trust the experience intuition thing is if it's with real money. The algo doesn't necessarily have to be with real money if it's set up correctly. If you just say 100% I'm taking those algo trades. But with discretion, you've really got to be taking real trades. Otherwise, I wouldn't buy into it. My simple phrase, I know a ton of sim trading millionaires. I know very few real money trading millionaires. And there's something to that. Okay. Whoops. Lavro said, and we got a couple more questions, and we'll get to the book giveaway. Again, I'll get you out of here by 2:30. Once a strategy is created, is checking how it trades on every signal. Let's say allow 10 trades in the same direction, help determine the robustness. Yeah, so what he's asking is, hey, if today it says go long and tomorrow it says, oh yeah, still go long, and the next day still go long. Does that help? I've never really looked at that because I just take that first signal. Now you could say, well, maybe I should take the second or third signal. You know, you could probably test for that. Okay. Do you think two more questions? David saying, given how difficult it is, do you think trading's worth it compared to pursuing other endeavors? Honestly, for most people, it's probably better. If you don't have the time, you don't have the desire, you don't want the mental challenge of puzzles and that kind of figuring out the market. Hey, it's probably easier just to put all your money in a ETF, a stock market ETF, and go off and do other stuff. Because you can still get 10% a year on average over a long period of time. You know, certainly I don't put all my money into trading. Um, I do other stuff. You know, I have retirement money that's totally not algo trading. So I'm diversified. But, you know, it's kind of like saying, would you want to get into real estate investing? Is it better off? Is it worth it? Well, for some people it is, other people it's not. So you got to be really dedicated. And it's like anything else in life. If you want to succeed, you've really got to put yourself to it, put in the time, put in the effort, and, you know, hopefully you'll still succeed. But you can do everything right. I'm sure there's people who've bought McDonald's franchises and failed, you know, just because 90, 999 or however many, no, there's 1,000, 10,000, 50,000 McDonald's. Doesn't mean every owner succeeds. All right, last question. Do you have any news trading events because slippage tends to be high, which deviates from the back test slippage? Um, so what you can do is you can program it to not take trades during those news announcements. That's one thing you could do. I'm not a big fan of turning things off because you did your back test with them on. So you got to be careful about that. You could always just up your slippage estimates. Uh, the slippage, I give out estimates in the class, and that's based on uh, normal slippage, along with it includes some things for rollovers, it includes news events, and it all averages out to a value. That's what I share. All right. So let's kind of move on to the book giveaway. And Sanjeeva just said, thanks to your book on algo trading, I improved my algo so very well. Well, thank you. I'm assuming that might be my first book. This book giveaway is for my latest 4 books. You get all of them. You get PDF versions of them. So I'm going to wait for correct answer, and the third correct answer and the fourth correct answer will get copies of all 4 of these books. I'm going to give you a countdown, 3, 2, 1, and then show the question, and then you just answer it. And whoever the third and fourth, excuse me, people are, will get it. Ready? 3, 2, 1. Name 1 bad observation you saw today. Okay. All right. You can stop. We've got answers. So we've got Zamir said, Zamir's got all the books. So you wouldn't have won anyways. He was first. Over optimization. Adrian said no slippage. Ibrahim said odd date. So you are a winner. And Julia, you said over optimized. That's another one. And all 10 of them, and a lot of people had a lot of other answers. So Julie and Ibrahim, send me an email and just let me know, and I'll send you a copy of those books. So here are the 8 that were bad. Remember, 2 were okay, but you should still look at them. But I'll tell you, if you just use these as sort of your initial vetting of a strategy or anything you see, you're going to eliminate a lot of garbage. And that's big for your trading. So anyhow, I hope this helped you today. Don't forget my YouTube channel, Algo Trading with Kevin Davey, or if you type in my name, trading, you'll find it on YouTube. You can go to my website. I have a lot of research that I've done, pretty original research. No one else has done this stuff that I've seen. And obviously, if you want to really accelerate your trading, Zamir just gave the best testimonial at all. I didn't even ask. Uh, consider my workshop. I think you will be definitely happy with it. And as Richard said, great webinar, gave me many great things to think about it. So, all right. Well, with that, we'll let you guys go. And thanks for watching. All right. Bye, everyone.